U.S. natural gas futures extended their surge for a third straight session on Thursday, driven by a powerful mix of technical breakouts and rapidly tightening fundamentals. Overnight, prices decisively cleared the December 5 main top at $5.50, shifting market structure firmly to the upside. February natural gas, the nearby contract, continues to significantly outperform March, underscoring the urgency of current demand rather than deferred consumption. This front-month strength reflects immediate heating needs and active storage withdrawals, a dynamic that is typical during winter rallies. In contrast, summer advances tend to be more measured, as cooling demand builds gradually and lacks the shock factor associated with extreme cold. As CME Group notes, winter rallies are often sharper and more volatile because cold weather can trigger sudden spikes in heating demand, rapidly draw down storage, and magnify any production or delivery constraints. These conditions can push prices dramatically higher in a compressed timeframe, unlike summer demand, which usually develops more slowly. So far this week, February natural gas is up an extraordinary 85%, while March has gained 37%, highlighting the market's focus on near-term supply stress. The catalyst remains weather-driven. Forecasts calling for Arctic air plunging deep into the U.S. are boosting heating demand while raising concerns about freeze-offs and temporary production disruptions. Weather analysts warn that a massive Arctic cold front could push below normal temperatures as far south as Texas, impacting more than 150 million people across 24 states. Such conditions materially increase the risk of outages and reduced gas flows as water freezes inside pipelines. Fundamentals tightened further with Thursday's EIA storage report. The agency reported a -120 billion cubic feet draw, exceeding market expectations near -105 billion cubic feet. Total inventories fell from 3,185 to 3,065 billion cubic feet. While supplies remain 141 billion cubic feet above last year's levels and the surplus stands at 177 billion cubic feet versus the 5-year average, the incoming frigid pattern is expected to rapidly erode that cushion. Current projections suggest surpluses could flip to deficits by the end of the month if cold persists. The rally has now carried the market into a test of the high at $5.50, a key resistance level. A clean breakout above this zone would likely accelerate upside momentum, opening the door to the $6 technical objective. Nevertheless, the odds remain low. With the winter demand window closing, rallies of this size are typically speculative in nature rather than fundamentally supported, which raises the risk that the spike proves temporary. On the downside, former resistance at $4.80 has now turned into first support. A deeper pullback would expose the 50-day moving average at $4.21, followed by the 200-day moving average at $3.54, both of which represent major trend-defining levels. Looking ahead, the strong outperformance of the February contract signals that traders view this as a short-term, event-driven rally rather than a long-duration bull market. That said, February futures can continue to strengthen into expiration next week if weather risks remain intact. Any meaningful shift toward warmer forecasts would likely cap the rally and invite short sellers back into the market, but until then, momentum and fundamentals remain firmly aligned to the upside. Don't forget to hit that like button and support me to help keep this channel going. And don't forget, leaving a comment really helps support the work I'm doing here. Thanks for being here and I'll see you in the next one.